All right, so I'm Pat Westfield,
I'm Tanner Moonen.
and today we're going to be talking about how the day coronavirus nearly broke the financial markets. So, the 2008 financial crisis, everybody looks at that as a disastrous time period within the U.S. economy. But on March 16th, 2020, will go down as a day that all investors will remember. The Dow experienced its worst drop as on its record as it plunged 13%. And the market was starting to tumble, and companies began to unload treasuries as the coronavirus started to trickle in. The coronavirus quickly evolved into a financial crisis as it shuttered many businesses around the world while sending financial markets in a flux where volatility is sky high. During a crisis like this one, the saying cash is king is justified as liquidity becomes tough to come by.
Liquidity at the macro level or on a company by company basis?
I would say company by company because they would have less cash to finance their operations. So the cash is king. Like if you have all your money held up in treasuries and bonds, you can't take that money out and service it to operate like your company.
Okay. Do you think there was any concern that there wouldn't be enough, the banks wouldn't have enough money to fund all the lines of credits company had?
Yeah, the banks struggled to unload because all the markets just dropped at that point so bad that everyone was in a panic mode.
It happened so quick too. It wasn't like over a whole period of time.
Yeah.
It was so like rapid and quick. So nobody was like used to it. Like 2008 was a little bit different. It took time. Over time, it dropped.
Okay.
Here, it just kind of.
Yeah, I was reading. They said this was more like a car crash when the 2001 was more.
Well, that's a good analogy.
Yeah.
I like that. I didn't hear that one.
Mm-hmm.
All right. So the Fed actually set the stage for what was to be expected because, like the weekend before, I think March 16th was a Monday. So I think Sunday night they like announced something. So the decision was to slash interest rates, which caught business attention with the coronavirus as it started to take a toll on everyday life. And liquidity from the markets was being voided as they attempted to make the financial system safe. So companies who would not afford to pay creditors or even meet payroll were at a very high risk of failure. So the Fed stepped in and purchased $700 billion in bonds in order to free up the market, as well as making it easier for companies to take the loans.
Weren't there interest rates low before this?
I believe they were, but after this, they cut interest rates to nearly like zero.
But is that going to incent people to borrow? I mean, if I have a project that I want to fund and the market, we don't know what the consumer's going to do, why would I be borrowing? I mean, a lower rate isn't going to make a project any more profitable.
Well,
I mean, if we're thinking that the interest rates were say 1% and they go to zero, if a project can't make money at 1%, is it going to make any more money at 0% interest rate?
Yeah, I know what you mean. In that though, it's easier to borrow the money or you're paying back less. So I guess it makes the project more enticing and more. Your company becomes more eager to start it. So it's like, all right, the interest rates are this low. We should start this project that we've had in the works for a while now. And that's what the federal government wanted. Want more circulation.
Should we let the invisible hand work on these companies who can't afford to pay creditors? Shouldn't the invisible hand of capitalism come in and just let them fail and let the strong survive?
That's true. That's true. If the federal government backs out and they say, no, I'm not going to help you out anymore, then yeah, those companies, they'll get weeded out. That's a huge key part because if the federal government's right now, they're still releasing monetary policies and everything. If they just drop out, then those companies that are doing poorly will definitely be at a disadvantage.
Okay.
And the $700 billion in bonds was huge because it like unclogged the whole markets.
So it created a market for bonds where nobody and investors didn't want to buy them, so the government bought them.
Mm-hmm. Mm-hmm.
Well, if nobody else wanted them, are they worth anything?
I'd say no.
Think about it.
It's good to think
If
about.
the market didn't want them and the Fed bought them, are they really worth what they paid? Because nobody else would buy them.
Mhm.
No.
A willing buyer and willing seller couldn't agree on price.
True.
What do you think?
I would think, yeah, they were essentially way less than what they thought they were going to get out of them, but no one else was going to purchase them, so here the federal government has to come in and help them out.
Chris?
I was going to echo the same thing too. I would think there wouldn't have been demand before, so I don't think they were an attractive thing before.
So the government could lose on this. The Fed could lose on these bonds if companies go up.
Yeah, but I think the more important thing is you have to try to get liquidity in the markets and money flowing in the economy, because the point of government is not to make a profit, but to keep cash going, at least with respect to the Federal Reserve. So yeah, that's my hot take on this.
Connor, what do you think?
Yeah, I think that the bonds would definitely not be worth their face value if the Fed had to come in and buy them because no one else wanted them. So
Is that a good thing?
I guess it's a good thing that they took the bonds off their hands,
Okay.
and it helps the economy.
Okay. Olivia, what do you think?
Yeah, I pretty much agree with what everybody's saying. It's good that at least somebody was able to purchase these and keep companies healthy. Hopefully that once this all starts to deflate a bit, they'll be able to be sold back.
Okay.
$700 billion is also
That's a lot of money.
Yeah.
Wasn't the first stimulus package under Obama also $700 billion too?
Yeah, I think you're right. Except it took a long time for it to come out.
Yeah, this one was really rapid.
Hmm.
I'm not that good with the history on the 2008 financial crisis, but
Yeah, some of us lived through it. You guys were just kids at that point.
yeah.
So what was the cause? Short-term corporate debt holdings are considered to be safe and liquid, in part acting as a checking account for companies to use for daily finance operations. When these short-term, often called cash equivalent debt, becomes less liquid, companies begin to sell their bonds in order to meet payments. This meant that people were reluctant to invest their money or buy anything even short-term, such as the case where PGIM, fixed income, was unable to sell short-term bonds issued by highly rated companies.
Whoa, stop for that. Explain that again?
So a fixed income company, they were unable to sell even short-term bonds by very high-repped companies. So even the safest of bonds, that short-term bonds, you think you'll able to pay them off very rapidly, they weren't even able to get rid of those.
Interesting.
And then this leads to a snowball effect where everyone pulls their money and is essentially the last person left with the bond in their hand, essentially uttered worthless,
And thus the Fed bought them.
Mm-hmm.
Right.
And everyone's fearful to re-enter the markets, and then it's exactly a snowball effect.
Interesting. Okay. See, the same thing essentially happened. The seize up in 2008, everything seized up because there were the collateralized or the mortgage, collateralized mortgage obligations.
Mm-hmm. That was the mortgage bubble, right?
Yeah. The same thing is that they had to buy them because nobody would. The Lehman Brothers was unable to sell the mortgage bonds they had in their portfolio.
So did that mean that real estate declined like rapidly during that?
Incredibly rapidly. You had a couple things happening at the time, both from internal and external to Lehman Brothers. And the first one was the nature of how you did mortgages had changed. in the past, you had to prove your income. Okay, I'd say, yep. I'd check with your employer. I'd make sure you had a down payment. I'd send a house inspector out, and I'd value the house by walking through it. So what happened is they stopped asking for proof that you make money. Okay, they wouldn't check with your employer. The second thing is they didn't require a down payment. Third thing that happened is they didn't do any in person. They started with a drive-by. Now, I don't know if you know about houses, but sometimes from the outside, a house can look great, but the inside is like really bad.
Foundation, like the roof.
Yeah, you got it. And so what happened on that is investors demanded so much money, mortgage brokers packaged these bonds. And let's just use an example. I say to Austin, you still with us?
I'm here.
Okay. Say, you got your special relationship there, and they say you're there as a nice couple. Everything looks great. And mortgage broker says to afford this house, you need $50,000, make $50,000 a year. Do you make $50,000 a year?
Moment, no.
No, but you're there with somebody you want to impress and keep happy. What do you say?
I make a couple million a year, yeah.
Oh, okay. As long as you nod it to 50, you got the loan. Could you afford that 50,000?
We'll worry about that another day.
No, not really. So what happened is they packaged these loans, and the underlying credit was bad. Just no way. So what happened is they were selling them because investors wanted more yield. They wanted to earn more than they could earn on other instruments. So they produced more and more of these bonds, and they sold them to investors. Now, as long as some payments were coming in, everything was just fine, and you assumed real estate prices were going up. But they weren't going up. People were buying property not with the intent of occupying it, but selling it at a few months at a profit. So the assumption was prices are going up. So if they figured a house was worth 200, they'd buy it and say, oh, I could sell it for 250. But if they had no money down and they couldn't make a payment, they had to take the house back. So what happened, it wasn't worth 200. So you had that issue going on, the underlying bonds. But what happened with Lehman Brothers is they sold the best quality credit into the marketplace and at a lower rate than the underlying mortgage. So say the average rate of the mortgages was 5%. They sold tranches out to investors at 2 or 3. They kept the ones that were making 8%. Now that's fine until payments stopped coming in. But as soon as payments stopped coming in, they had to mark them to market. And what's the market value of a bond where payments, the underlying business is not doing well? 0. So they couldn't value them. So then they assumed everybody who had a mortgage bond was in the same boat. So you couldn't value them. Or if you valued them, they came in so low that you had to recognize the loss, and that wiped out your capital.
Were they checking like credit scores at that time for? No, they just giving them out.
Minimal. So if you even had a 610, you could get a. You could get a mortgage. They were giving mortgages to everybody who. Think about it. If you're prepared, you're in a little bit in the investment business there. You have an option to sell something to somebody who is going to pay you at a 7% commission or a 1% commission. How hard are you going to work to earn that 7%?
Pretty damn hard.
Yeah. So now I'm a mortgage broker, and you get paid a commission for every mortgage you sell.
Right.
You want to do the biggest mortgage and the most mortgage you can do.
Right.
You don't care who it is?
Nope. Are you going to, and let's assume that you're very money focused, Patrick. Would you sell them the 7%, even though it may not be the best, if you know you can make a 7% commission on that?
Wait, so you got a
it depends how much.
Connor, go ahead.
you got a 7% commission from selling to people who can't afford it?
Yeah.
And then only 1% to people who can?
I'll just say the old method of selling them the right way.
Huh.
What would you do?
It'd probably be a flat commission for all customers, I guess.
But if you got paid 7% for everything you could generate, how hard would you work to generate those loans?
Oh, yeah, I'd be going for the 7%.
Absolutely. Would you be trying to sell them to people like Tanner and Austin and Chris?
I'd be trying to sell to everyone here.
Okay, you got it. Is that the right thing for all of us?
Oh, it's probably.
Yeah, it's probably not.
And that's what was happening here, coming back, except these were really highly rated companies that couldn't sell. The market wasn't taking them. So that'd be like Apple.
Yeah.
People couldn't sell an Apple bond. I mean, why? I mean, very interesting. Go ahead. But that's what off track. But it's the whole liquidity issue. How much is available and what's the value? And if you have somebody that isn't going to, if you perceive risk, then the market doesn't work. And if the market doesn't work, that would really stop things very quickly.
Okay, so the larger picture. Interest rates on short-term corporate debt soared and peaked at 2.43% on March 25th, which was the highest since October 2008. This meant that the repayment of debt was much more than anticipated, which put strain on companies looking to pay it back or trust that the short-term debt would be advantageous for other companies to invest in. Even a safer investment such as money markets, where large institutions purchase short-term corporate debt, had outflows of $60 billion in the ending week. The entirety of the economy should be worried when the safest of investments are considered risky, resulting in less circulation within the markets and obviously less money being transferred between hands.
So the effect of the pandemic, the virus impacted more than just company gains and cash flows, but rather the American psyche. So schools were closing, airports shutting down, nobody was able to travel, restaurants clearing out, and places becoming ghost towns. It instilled a fear atmosphere for like all Americans and even around the globe. Investments look profitable if the investor believes in the system that is at work in order to see profitable gains. So faith is a key element that impacted the fall on March 16th, because for the first time in over 12 years, the majority of the population had lost faith in their country. So this leads to a rippling effect, which plays a game of cat and mouse, leading to who, unfortunately, is the last one to sell their shares.
How was your psyche affected by this?
I don't know. I mean, it impacted everybody's daily life. From
How did it
kids
impact you?
School, for example.
Yeah.
Moving classes to online, not being able to come back right after spring break.
Did you feel good about it? Did you feel sad about it? Did you feel hopeful or you're angry?
Wouldn't say I felt great. You know, it was different. We were never like in that situation before. It was our first time, so it was definitely different. I wouldn't say sad. You know.
Yeah, just different.
Tanner?
Yeah, for me, I know like my family and I, we couldn't really go outside. We were kind of just like stuck in a house all day. So it definitely like plays a role on like your like mental state, I guess you could say like that.
Okay.
You're not interacting with people, and you can't go to restaurants exactly. The school's closed. So yeah, I mean.
Okay. When you say, do you think the faith in our country is fully recovered, or are we still?
You're talking about with the virus?
With everything going on.
Well, obviously the virus kind of got pushed behind a little bit with all the protests that were occurring. So almost like people forgot about the virus and kind of they're focusing on other things. So I think those protests definitely took a toll on it, and some people just completely forgot about it.
Other thoughts?
From a market standpoint, the market seemed to rebound like very quickly, very rapidly, which I thought was kind of surprising.
Okay.
I mean, from the coronavirus, with so many companies not being able to operate, and I assume that the federal government definitely had a huge impact in that, and kind of propping up the markets and all the financial systems with them printing money and giving out these beneficial loans to companies. That definitely helped them.
Okay. Other thoughts? It's a fascinating topic because, you look at that and say, we trusted that things would work out. Okay, keep going.
All right, so interest rates and repercussions. So city and state governments who rely on the reselling of securities to investors were terrified of rates jumping through the roof. The interest rates, which were originally hovering around 1.28%, were thought to see spikes to nearly 6%. Long-term debt was even being pulled as a large bond issuer, and Citigroup did not release a single new bond for sale. Companies such as Citigroup rely on these bonds in order to fund projects such as 4 new schools which were under construction. Without the cash infusion of the $150 million from the bonds, construction would halt.
So not being able to get liquidity to fund their new projects and new construction, which is schools, which we definitely need.
Okay.
So how can we recover? Millions of people out of work and people trapped inside their homes. The virus has taken a huge toll on the U.S. economy. As unemployment numbers spiked, oil prices crashed, the turn to technology for work and school, and limited traveling, this pandemic affected the entire globe, not just America. As companies begin to slowly open up the avenues in which they conduct business, the business will be changed altogether. It's going to shift towards more online transactions, and business dealings will be an integral part of the strategic business practices. So they have to change the way they operate business, whether it's Zoom calls discussing more business deals via online and everything. And I don't see people shaking hands anymore after a business deal, stuff like that. The Fed is able to stabilize the economy by guaranteeing mortgages from banks, so money can be lent out more freely. This is big for companies, as they know that it's big for banks, as they know that the mortgage that they do lend out will be guaranteed and will be paid off.
What's the one issue if you have to issue debt?
Being paid back.
You got to pay it back. Where does the payback money come from?
Whoever you lend it to.
You're the company that borrowed.
Yeah.
You now got this low interest rate.
Mm-hmm.
What do you got to do to be able to pay it back?
You got to make money on that.
Which relies on what? People spending.
Mm-hmm.
You think people are going to spend?
I think eventually people will be.
You use the word eventually. Why did you use the word eventually?
Well, I think we're in phase 2 right now. So as America starts opening up, people will be a lot more outgoing with their money and just stimulus more,
Okay.
Yeah, I don't think people could, everybody's going to get back to their normal lives. People are already starting to. It's been so long. This isn't going to take a toll on them for years, Okay. It might for some people, but people are going to start going out. They're going to start spending their money like they used to.
Okay.
Obviously, with work, it's a little bit different. Work moving to online. I know a lot of people are still online, but I think people are going to start spending money.
more money being borrowed at cheaper interest rates means that people spend more, obviously, because they're getting money at a cheaper discount.
All right, so our outlook. So the key takeaway is that the future is uncertain. With 2020 being a year of social distancing, this has led to far less consumer spending, meaning that people are saving more. The financial markets are constantly changing, which leads to big swings within different sectors. The best advice is to trust sound and proven companies with efficient business practices. A recession will ultimately weed out the lesser companies who cannot survive without federal funding. We hope for a better future, although factoring in the fact that at any moment the roof could cave in, leaving the rest of America scrambling.
Okay. Let me, questions, comments on what they've said. The key learning points, one, you need to have this liquidity in the system. Without liquidity, everything can come to a halt. So I think that's positive. Why don't you not share from me? I want to switch over to something else real quick to talk about this. Oh, I can do this. I can do this myself. I didn't realize that. I could just cut you off like that. I can mute you too. If you were talking, I didn't like what you were saying, I can mute you. But I think when you look at low interest rates, there's a couple of ways to interpret that. I just brought up looking for what interest rates actually are today that I could buy a bond. So what I did is I went in and I said, okay, I want to buy an investment grade bond maturing in 20 or to 21. Look at what I'm getting for a rate. 0.31, 0.54, 0.03, 0.153. Here's one at 140. I don't know what this company does, so it's probably worth looking at. But right up through a year from now, the most I'm going to make, like 10, 15 bips.
Mm-hmm.
What might that be telling you? That interest rates are so low that I'm willing to accept this Barclays note from January. I'm willing to accept 37.5 basis points to buy that bond. What is that telling us about the what do you think is going to happen with inflation? What does the market think is going to happen with inflation?
Inflation is probably going to sky.
I didn't hear you.
I don't. I wouldn't. I don't have a. Sorry.
There's no inflation.
There's no inflation, yeah.
So now, if all I could earn on this one, say, is 17 basis points, what is my other option if I'm an investor? What and I have money? Is this a real good thing for me? Am I going to get rich on this?
No, you will not.
So what might I do?
Maybe go over to the equities market.
Right. Okay. So if I go to the equity markets, Altria Group, also known as Marlboro, what's their dividend yield?
Wow, 8.34%.
Yeah, so if I can make 0.175,
Yeah.
why wouldn't I stay with Marlboro?
Mm-hmm.
Even if is their business going to be negatively impacted by a recession? People going to stop smoking because of the recession?
No.
I don't think so. If anything, they might be smoking more.
Oh, yeah.
Yeah. And look at some of the other products they're doing. Are they really? So let's assume that even their price cuts in half, it's still 4%. So an investor, am I going to move money into equities instead of in bonds because my return is higher? Huh. Interesting.
Think about it, yeah.
So now let's take a look at junk bonds. You've heard that terminology, everybody?
Non-investment grade
Pardon?
companies. Non-investment grade companies issuing bonds.
Yeah, that they all got some credit issues. Let's see what even the junk bonds are selling for. Okay,
Oh, wow.
0.54, 0.25. I have that one. I bought it earlier. Safeway. Now, this is an interesting one. Why is Safeway stores at 2.5, but I got to buy 250,000 of it. Okay, 108. Sprint 0.35, Xerox 0.9, Simtech, Navient. Well, here's one, Transocean 21%.
Wow.
Well, Royal Caribbean, I can make 360. Anybody think the cruise line business is going to come back anytime soon to be able to? United 5.9. Connor and Chris, we were having this discussion on airlines before. Would you take a risk at 5.9% with United?
Probably not.
No. Briggs and Stratton, you've heard of Briggs and Stratton if you ever cut the grass? 458% return. Yeah, but again, they're in, you ain't going to go anywhere. Ford Motor, I like the yield. I would buy this. Okay? 346, I like it. I think Ford, this is the credit. These are the car loans. Okay? I feel good about that.
Well, what was that bond with a 400% yield?
Yeah, Briggs and Stratton.
Briggs and Stratton, Jesus.
They make lawnmowers and lawnmower engines.
Aren't these like insured by the FDIC?
None of these are. These are all private. These are the bonds that Tanner and Patrick were talking about. Okay, and if you look at it, they have weak liquidity, high leverage, negative free cash flow, near-term debt maturities, low growth, margin pressures, seasonality, cyclical, and business. So, the strengths are they got well-established market, strong brand recognition, but when we go back to it, they're selling for, say I go to buy it, it'll tell me how much I'm buying it for. It's okay, it's got a 6.875 coupon.
Okay.
And it matures 12/15, so that's what, 6 months? Matures in 6 months. The current yield is, if I'm going to yield to maturity, is 458%.
Worth the risk.
So I could buy 10,000. Let's just look at this one because I think well, right now I could buy 5,000 of it for $15.90. Do I take a chance with that, or do I buy Philip Morris where I think people are going to keep smoking, or Altria?
I would trust Altria.
Yeah, I'd stay with the smokers.
Yeah.
So these are sort of the decisions the investors have to make, but this comes back to the liquidity of the company, is the ability for free cash flow to really service the debt under a stressed condition. Because the cash flow is going to significantly change for every company. So you got to look at it that way.
I was also looking at the S&P/Y, and of like the 500 companies, there's maybe around like 15 to 20 that are in like positive, that are like doing well during this time, and the rest they're propping up the rest of the S&P/Y.
Oh, absolutely. Look at the dividend yield on the SPY is 189. So you start looking at that and say, well, why would I keep money in bonds making 20 bips when I could earn 189? Now, as you pointed out very validly, there's only some companies making a lot of money. But this is what's pushing the market up, is the fact that the alternative investments are nil. You don't have a choice.
Yeah, you have to go with equities at this point.
Yeah. Now, here's a text I just got from my brother-in-law. Okay. And he works for a company called IHS Markit. You might have heard of them. They're one of the largest information providers for pay. And here's what he texted me at 10:33. Beijing under lockdown again. New strain of the virus. More infectious.
That's good.
Oh, yeah, isn't it? You're like, oh,
Yeah.
is my response. But the financial markets today, if we look at it, what are we up? The SPY is up 1.45% today. So the market doesn't seem to be concerned that Beijing is now under lockdown. There's a new virus. I don't know.
Are they going to tell us? That's the question.
I don't know. I don't know. So, a good thing. So this is what another good discussion. Any closing thoughts? What did you? Let's go through what you learned from all of this. Chris, what did you learn from our discussion this time?
What I learned a lot more about, like, you know, the intricacies of the 2008 financial crisis, more about like the current bond situation. I guess that's like my big takeaway from this.
Connor.
I guess I learned how the American psyche about the pandemic is affecting the economy right now. Like, people are not spending as much, like going to the mall, or obviously with airlines or with cruise lines, vacations. Yeah, everything's just slowing down, and it makes sense.
Okay. Patrick, what did you learn? Either by doing this or from listening to having the dialogue?
I'd say, since like being a business major and wanting to go into the finance section, it's clear that going into the stock market is it's a risky business, and there's a lot of repercussions, but there's also a lot of opportunity.
Yeah, I agree. Austin.
What I learned is that, you know, I think between everyone here and for the majority of the American population, that, you know, I feel like everybody feels the same way about where we're at with, you know, opening back up again. That, you know, a lot of people are still concerned that, you know, not everyone is sold that the virus is completely gone, that it may in fact come back in a second wave. And now what your brother-in-law is saying today doesn't sound promising. So I think we're not fully out of the woods yet, and this all these phase 2, phase 3 reopenings might be too soon.
Great. Tanner.
Yeah, I'd say, to piggyback on that, I'd say with investing, and from everybody here, when we do get involved like heavily with it, that the markets, anything can happen. So we have to manage risk and just be aware that that money could be gone at any moment. Any spike or any drop could be detrimental to everybody.
Okay. Olivia.
Yeah, I agree with what everybody's saying. I would also like to talk about the psyche. The fact that coronavirus has affected everybody differently, and the way that people look at it and their hope for the future and the stuff that they're buying, and how that really reflects how the stock market is doing, how people are spending their money, and how they'll continue to do that moving forward.
Good. Okay, that takes care of this one. Now